Can you hear me?
Yes, now we can
Now I
hear
can
you.
hear you. Before I was not hearing you.
Okay, I'll just start over. So my name is Asiko Gashambi, and I'll be the host for today's session where we'll be discussing matters policies. And I'm just going to introduce the speaker for today. Her name is Mercy Andaro, and she's a graduate from JKUAT, currently completing an MBA at Strathmore Business School. She's a certified insurance professional with over 25 years of diverse experience in the insurance industry. She's a certified coach and member of the International Coaching Federation. She's a certified professional trainer, entrepreneur, and principal officer of Custom Fit Solutions Insurance Agency. She's a wife and a mother of 3, a published author of Whispers in the Closet, a Christian devotional book, and she has been contributing author in the management magazine and insurance industry publications. Mercy, karibu. Here with you, you have a community that went through an investable course offered by Africa's Pocket, where they learned matters money, investments. And so we are happy to have you and just hear you share your experience in the insurance sector. Karibu.
All right. Asante sana. Thank you for the kind introduction and remarks. I consider it a privilege to be here today, given that you guys are really students and graduates actually of an investment. So I'm privileged to be talking to people who are well versed. I trust Asiko I have rights to share my screen. Is my screen visible?
Yes, it is.
All right. Okay. Right. So asanteni sana. I'll get right into it, given that we're well into our time. I think we are 9 minutes past the time. So the topic I was given today is education planning and incorporating now education policies, which I guess is where my strength is in. And even as we start, I think that has already been given. So in terms of what we'll start with, what we'll be covering today, we'll be going through starting with the end in mind, and this has to do with your goal setting. And then when it comes to education, planning and policies, what are the things that you need to consider as a person that are internal to you? Then also, what are the various external considerations that you need to consider and their impact on your plan and even maybe whether or not you take a policy. Then we'll be delving right into the policies and we'll be looking at the key definitions and features of education policies. What do they cover? What are the pros and cons? What are the key terms and benefits? And also trying to address some of the questions that, that came up that were shared beforehand. Then we'll be looking at case studies in terms of how do we then apply what we'll have gone through into actually, practical case studies that then are more meaningful to us. So we'll get right into it. And starting with the end of, why starting with the end in mind? When it comes to planning, there's always a goal at the end of it. And education is really, is no different. And I'll just share my own story, why it's important to plan and to plan early. I think sometime that must have been my second employer. I happened to be working somewhere in Rose Avenue, where the then Singibora school was based, their main school was based there. So my daughter then, my firstborn, you've been told I have 3 children. So my firstborn currently right now is in university, 20 years, in her 3rd year. So then she was 6 months. And so I walked up to Singibora, I was looking to get her enrolled, when she turns 3 or maybe 2.5. And, when I got there, lo and behold, they told me, you're too late, and we can only now enroll your next child. And you see, that caught me off guard, because that is really a school, is a school I'd wanted my daughter to join. But then, because I had not done enough research and in good time, then she was not able to join. And so when it comes also to your own education planning, it's very clear to be, where do you want your children to go? And that's all the way from, kindergarten, primary school, high school, and even university, and even after, if you're going to, pursue further education. So be very clear. When your why is clear, then the plan becomes easy, and then you're able to weigh options. So I'd say we'd first start with personal considerations, and these are some of them, are very interesting, and in terms of how they affect our plans, and even, what we want to do around our children. So your legacy and family history. For example, we have families that have a tradition. All our girls, go to a certain school. All our gentlemen then go to a certain school. And so sometimes when you're planning for that, and if that is a culture that's really, embedded either in your own family, or that of maybe your spouse, then that can become an influencer in terms of, the kind of school, the kind of education system that you choose for your children. Then the other thing is past experiences, and these are good and bad. I remember, well, secondary school, my experience there was not very good. A strict Catholic school, one of the prominent ones in the city. But out of my experience there, when it came the time to choose secondary schools for my daughter, I was very, averse because of my experience there. So if your experience was good, then you sort of want to push your child in the same direction. If your experience then was not very good, or the experiences for people was not that very good, then you'd find these influences, the kind of schools and the kind of system that you want for your child. Again, prestige and reputation, keeping up with the Joneses. And this has a really, especially for middle class families, prestige and reputation. Where does your child go? It must be a group of schools, it must be an academy, it cannot be a primary or, of just ordinary secondary school. So sometimes these are some of the drivers of, that really influence us. Sometimes we may not be aware. It's what lies behind the surface when it comes to choosing education for our children. Then your age, and we'll be looking at why your age matters, especially when it comes to education policies. And also now your children's age, because it depends on if you're starting to plan now and your children are more advanced in age, then it means you have less time, and it means then you need to put in a plan that is really an accelerated plan, as opposed to someone who's starting maybe even way earlier, before they even get their first child, that they're already thinking in your children's age. And then your current income, because really income will determine what you can afford. And don't just look at your income today, also look at your future income earning capacity. Because today, again, and this is also tied to your age, you could be quite healthy, working in a very good job, earning quite a bit of money that you feel is comfortable enough to be able to afford a certain, caliber of education for your children. But, a few years down the line, maybe you're approaching retirement. And, looking at your pension benefits, if any, or, the investments you'll have put in place, they may not be enough, to sponsor the education of your children. If they'll still be then, in school by the time you retire. Again, things happen, accidents happen. You could get a critical illness and you're incapacitated, and, this prevents you now from working. Do you have a contingency plan in place that can help you then, continue, that can protect your income and ensure that the dreams you have for your children are still valid and will still come to pass? So as you're thinking through, think through your timeline. Where are you now? How old are you? How old is your spouse? How old is each one of your children? And you're projecting another 10, 20, 15 years. Where will you be? I mean, what are your life goals? Because you see, perhaps you're thinking of retiring early. Maybe your plan is by 40, 45, you're out of employment if you're employed, and already doing something different. Maybe you're in business, entrepreneurship, that kind of thing. Then project how given that kind of goal in the future, where does education fit in? How old will be your children by the time you retire? and what is the impact of that on your ability to afford an education. So I hope we're clear on what personal considerations, even as we're coming up with a plan, and some of these are subtle. It's only when something really happens, and why it's important to interrogate them is sometimes when, you know, situations change for you. Maybe you have to downgrade because you've lost income, you lost a prestigious job, a high earning, you know, job, and now you have to take something that's not as lucrative. Will you still cling to, you know, taking your children to the schools that, you know, you had intended? Maybe the plan was not quite in place. And what really informs that? That, you know, you're going to die, you're going to take a loan, you're going to kill yourself, you're going to borrow, you know, to ensure that your child remains in that school. So what is advice in this? Is it pressure from family? Is it prestige and reputation that, you know, you dare not have your child in another school? Is it, you know, experiences, those kind of things? So it's important to interrogate this even as we start our planning process. Then external considerations could be now the type of school system. And I think Kenya, we have now the 844 that is dying out. I think we have the last group of class 8s sitting, you know, sitting for KCPE this year. And in another 4 years, then, you know, that will be over and done with as they get into university. We're still trying to understand it, the new CBC system. Then, of course, there's the IG, the British curriculum, and we also have now other, you know, other school systems, ACE. There are those maybe who prefer to do homeschooling. So what is the impact of that on your plan? Now, schools, when we come to looking at schools, sometimes you're thinking about facilities. You know, of course, you can't compare private schools and public schools in terms of facilities. You're looking at the teacher to student ratio. You're looking at the sports facilities. You're looking at just even the teachers, the caliber of the teachers there. And also, what are your desired outcomes? Are you looking for a child that is, you know, more academically inclined? Or are you also looking for, you know, a holistic kind of education where even you know, gives talents, extracurricular activities are considered? Then again, accessibility, which is key. You know, you don't want your children driving all the way, you know, across, you know, town to get to their school on a daily basis. That can have an impact. Or sometimes if really the school you want is all the way across town, I've seen people having to move out of, you know, maybe you built a house, but you have to move out of it, go rent for a while, you know, just to be near your school, the school that your children are going to, because there's an outcome you want out of that school. Then again, cost and affordability. What can you afford? What are the costs and what can you afford? So those are some of the external considerations, things that you need to think through when it comes to creating your education plan. I think that we've already covered in terms of school system. And since this is the most recent, it's still getting, you know, some people call it 26333, others call it 2663. And these are basically 2 years in the pre-primary, that is the PP1 and PP2. Then 6 years from grade 1 to grade 6, and that is covering both the lower primary and the upper primary section. Then we have the junior high school starting from grade 7 to grade 9. And then we have the senior high school from grade 10 to grade 12. And I've also put for you, you know, the ages of your child around here. And by the time they are done with senior high school and ready to get into now university or TVET, because those are the options given, then they're between 18 to 21 years. And well, as per the new curriculum, it's expected they'll do 3 years, but we're waiting to see how that pans out, because then we have, you know, most universities run a standard, you know, like either 3.5 year, 4 year course, or if you're going for medicine and architecture, then 5 to 6 years, also for engineering. So for cases, for purposes of our case studies, we'll be looking at this as the CBC system, since it's the most common and rampant currently in our country. And so we talked about cost as one of the consideration when it comes to education planning. And really, apart from those other things, you know, what outcomes do you want, what kind of facilities, where you want your child to be, then cost is a key factor. And some of the cost that you need to consider is not just the tuition fees. You also need to factor in meals, if these are not incorporated as part of tuition, transport, well, unless your child is a boarder. Then most schools, I think, now charge for extracurricular activities. If you want your child to be in a certain sport, if you want them to play a certain instrument, then there'll be a cost to it. Then the other incidentals, insurances, like personal accident cover, ambulance, emergency evacuation cover. I think those are now being incorporated in most schools. Then when it comes to cost, and this is something we'll really be looking at, is escalation of fees and the influence of inflation on fees. And I think we'll just combine them together when we are now especially doing the case studies. And you find some schools, will do a standard annual increment escalation of fees of maybe between 5 and 10%, I think is the most common. And then there are some who want to keep, they want to keep in line with what the inflation is in the country. So those are some of the things that you need to look at when it comes to assessing costs for education. I hope we're good until there. Asiko? Okay, I'll assume we're all good.
Yes, we are good. We are good.
It's good to get, for encouragement purposes, at least, one person to at least respond that, people are alive and well and following.
People write something on the chat.
Yes, yeah. And just to say, we're still here, we're on, we get it, or even a question that comes to mind even as we continue. So that is cost assessment. Now, when it comes to financing education, then we have different things that we can do around that. And much as I am very biased towards insurance, I am also cognizant that there are other ways of funding your education, your child's education. And the first one is from your income, and this is active income, either from employment or business. And it means then, you're working, it's either what your, salary that you're getting from an employer, or if you're self-employed, or you're a shareholder in the company, then the income that you're getting from there. Then the other ones are investments, and this could be now what we'd refer to as paper assets, like money market, the treasury bills, the bonds and shares. And the other form of investment, and here I'm talking about traditional sort of investments. Of course, now we have crypto, we have the Bitcoins, and many other interesting things that are coming up. But in terms of now traditional and what is easily available, you'd be talking about paper assets mainly, and real estate, like land, residential property, or commercial property. The other way people fund that is really not a good way of handling, because education is actually recurrent expenditure, and you don't want to fund it out of debt. But you find people then taking bank loans to finance education, especially maybe at, if your children especially are going to high cost schools, and sometimes when to fund maybe education abroad, then SACCO loans. And that's why every year they have what, they always, by December, everyone who needs to have, signed up for an education SACCO loan, it's become a common feature in SACCOs, as this is one of the ways people traditionally then would fund education. Then also now there are a lot of microfinances, digital ones, and the brick and mortar ones, the digital loans that are really rampant. Then of course, Harambee, we're Kenyans, friends and family. Sometimes, it says it takes a village to raise a child. And I think in our culture, sometimes people take it literally that your children need to go to school. They are your children. You have no plan around them, but there's always an appeal, especially around January, for people seeking to assistance from friends and families, to be able to educate their children. Now, the other mode is savings, and here we're talking about banks, and we're talking about saving through a bank account. You can save through a SACCO, and you can also save through an insurance policy. And here I'll be quick. I'll be quick to caution us and also to address a concern that had arisen. Education policies are not investments, so let no one front that to you as an investment. It is not. It is actually a form of savings. Because when it comes to investment, then one of the criteria is there must be a rate of return. That is the main thing. And when it comes now to distinguishing, if you put insurance and put it alongside other investments as an investment, then you'll find it quickly does not fit into that criteria for many other reasons. And we'll be looking at that as we look specifically at it as insurance as one of the ways that you can fund education. And what differentiates now insurance from either other savings and investment products is because of the element of risk management. That apart from you being able to save, I believe it's the only product that then allows you also to mitigate against risks. And you see, like when we talked about some of the things, but like I said, life happens. You could get into an accident and you're not able to work. You could lose your job. You're not able to work. There's that form of loss of income. There could also be, you're diagnosed with a critical illness, and we'll be looking at that. And so you're no longer able then to fund. You're not able to fund your education for your children. So insurance then comes in to offer certain risk management aspects that can help you mitigate against those risks. And this you'll not find in other savings products. You'll not find them in many forms of investments. And that is the main difference between insurance as a form of savings and other savings. And like I've said, insurance is not an investment. It is not. So I hope you're clear on that, because next then we'll be jumping into key definitions. So now moving specifically into the area of insurance. And it's important that we understand some of the key terms and definitions that are there, so that then, when you see something in a policy document or someone is talking to you about it, then at least you have, you understand what they're talking about. And the first thing is a policy holder. And who's a policy holder? This is simply the person who's taking out the policy. So it's you who's gone to an insurance company, you've decided to purchase a policy, an education policy or any other policy, then you are considered the policy holder. And for a policy holder, you must have an insurable interest. It's a key principle of insurance that not anybody can take out any policy. There must be a relationship between you and what you're seeking to cover against, in such that you stand to incur a financial loss, should a risk occur. So for example, a common thing would be, say, like motor insurance. So your car, it must be either your car, either a car that is yours in terms of that you own it, or a car that you have access to, that you are the beneficiary owner of. So it may not be your car, but you benefit from its usage. And if something happens to the car, then you stand either to be inconvenienced, but you also stand to suffer financially. So the policy holder, in determining who can become a policy holder, insurable interest is a critical, insurance concept. Then when it comes to beneficiaries, these are the people who've been nominated to receive benefits from the policy, either when the policy matures. And maturity is when, you've chosen a certain, you want this policy to run for 5 years, 10 years, 15 years, 20 years. So at the end of that period, that the policy is said to mature. So these are the people. So the beneficiary can either be you yourself as the policy holder, or you can nominate beneficiaries. And since now we're talking about education policies, the beneficiaries then will be your children. However, if the children are age 18 and below, you will need to appoint a guardian. So it could be your spouse, it could be a trusted relative, maybe a parent, your parent, a brother or sister, or even just any other guardian who then will ensure that in your absence, that the intention for the education policy, that the funds actually go towards educating the child. So those are the beneficiaries. I think we've already talked about the policy term and period, and we say this is a period of insurance. It can be 5, 10, 15, or 20 years, for example. Then you'll be hearing me talk about payouts. And what are payouts? These are payments made from the policy either once at maturity, or because here we're talking about education and you're seeking, you're seeking to fund education over some time, then there could be, a number of payouts being made in the course of different intervals during the policy period. So for example, you're seeking to fund education in university for your child. So maybe right now, maybe in 10 years time, that is when they get to university. So you find in that year 10, there could be a payout, year 11, when in the second year, there'll be another payout, third year, fourth year, that way. So that is how you structure. And the payouts can either be one payout, at the end of it, or before they start school, or it can be something that you structure a number of payouts over the policy period. So I hope we are tracking. So the next thing that we need to address is critical illness, because you see this coming up in education and even in other kind of policies, even medical insurance. And critical illness is normally a terminal major illness. Normally it has no cure, and it will be something that you need that is life-threatening. It can also be terminal. And either if you survive it, then it will give you some form of incapacity that you're not able to continue with your life. Either you'll not be able to go to work, or if you go to work, then you're not properly able to do the job that was giving you an income. So examples, and something important to note here, not all critical illnesses are covered. So when you take out your policy, please note which ones are covered, because sometimes this is where then people get into trouble with insurance companies. Your doctor could diagnose you with a critical illness, and true enough, it's a critical illness. But as long as it's not defined in the policy, then you find it is not coverable. So for example, the major ones, the ones that are common across insurance companies are like cancer, stroke, heart attack, kidney failure, paralysis, coronary artery disease, and if should you undergo a major organ transplant, like say like a kidney transplant, then that is normally across most insurances, these ones are considered to be critical illnesses. So take note of them, make sure you check on your policy so that then you're sure you know what you're covered for and that it is adequate. Now, disability, I think we've touched on this, and is any incapacitation that arises either from an illness, say a critical illness, or even an accident. Then you find policies have what, and I think insurance people, we really like to hype on this one, bonuses, the policy has bonuses. And these are amounts that are paid in addition to the prescribed policy benefits. So you could find maybe that in addition, say maybe this policy is going to pay you 5 million after some time. Then you'd say in addition to this, it's going to pay either bonuses at a certain amount, either was the sum assured or even as, in terms of what you've accumulated to date. So every policy has its own, and every insurance company has the way in which they calculate their bonuses. So the next term is sum assured, and this we use for life insurance policies, any policy that's on the life side, and education is considered to be on the life side. So the sum assured is the policy value amount that is payable in the event of death of the policy holder or upon a maturity of the policy. Then we have this term that people love to hate, surrender value. We'll be talking a bit about that when we go through a case study. And this is the money paid to the policy holder if you terminate a policy before it has matured. So say you are taking, a policy that has a term of 15 years, but then I'll give two scenarios. Either after 2 years, either circumstances change for you, the policy you feel did not quite meet your needs, so you decide to terminate it. Now there'll be different things that happen at 2 years, below 3 years, and after 3 years, and we'll be talking about that. Excuse me. But I think that money will be paid should you terminate the policy before it has matured. And sometimes these can be very disappointing, and it has left very many people disgruntled and very disillusioned about insurance. And we'll be, as we cover now the policy features, we'll be looking at that a bit more deeper. Then we have what we call, and you'll see it on the policy, waiver of premium. And what happens is, in the case either you've been diagnosed with a critical illness, or for the first time, or you have permanent disability, maybe arising out of an accident, or if you die. You see, this policy you are taking for your children, say you've taken like say the 15 year one, then say maybe after 10 years, unfortunately you pass on, then what happens, there were premiums that you are supposed to pay for, the entire 15 years. So what will happen at that, if there is this waiver of premium, it means then you stop, any premium payment stops, but the benefits continue. So you find at year 10, you will no longer be required, of your beneficiaries will no longer be required to pay premium, but the cover will continue to run until year 15, maybe when the payouts were supposed to happen. So that's an important one and a critical thing to look for. Sometimes there are people who charge for it, some insurance companies. Again, education policies are not the same. Every person, every insurance company has, the way they have put theirs together is the way they've calculated the way they've calculated their benefits, and even the riders that they have attached to it. And especially nowadays, we find even with one insurer, they have like 4 different, with the same company, they have 4 different, insurance education policies. You find this one called Scholar tomorrow, another one called Elimu something, another one called Education Plus, those kind of names. So what I've done here is try and take what are the generic features of that you'd find that are common in any education policy. So I hope we are clear on what are the key definitions. It's important to really, since you'll be getting this, to really just take note of them. And if you already have a policy, it's important now to go back and read and see what your particular policy has to say as far as all these things are concerned. Because like I said, no policy is the same, and every insurance company also has their own way. And sometimes even within the education policies, their portfolio of education policies, everyone is different. So moving on, now we'll be looking now at what are the features? What are the features of the key features of an education policy? And one, I think we've already said this, it allows you to save for a desired target amount over a period of several years. So maybe you've done your calculations and you've seen right now your kids are a certain age. By the time they get to university, for example, since that's most common, maybe you require 10 million, for example. So this is the target amount, but you want it split either into one, paid out as one lump sum, and then you organize the funds for yourself, or you want it now structured over year 1, year 2, year 3. So that is what an education policy will allow you to do. Then it gives you agreed payouts, which are either a percentage of the total target amount, and these are paid out in defined periods over the chosen policy period. Then always for all, and that's why I was saying education policies are considered on the life insurance side of things, it always has an element of life insurance. And you see, that is what differentiates it from any other type of saving or even investment. And this pays out either in the event of the death or disability, or upon death, mainly upon death of the policy holder, or in case maybe you did not die, but then you're so permanently incapacitated that you're no longer able to continue with your normal way of life, either out of an accident, maybe you're paraplegic now, or you are diagnosed for the first time with a critical illness. Then the policy also may include optional benefits like what we've talked about, the critical illness cover. And here it's important to note that critical illness, please first note what is covered. It is not all, it is some, and they're usually defined in the policy. Then what is covered is only the first diagnosis. The first time you're diagnosed, then the policy pays out. Should you now be diagnosed with another one, say maybe unfortunately now you had cancer, And then after some time, then you needed to have a major organ transplant, the policy will only pay once on that critical illness cover. So it's important to note that. Then there are also what we call the accidental death and permanent disability. So normally the life insurance aspect will pay upon if the policyholder dies before the policy matures, then either out of natural causes or out of an accident, then you find then the policy will pay out. But then there's what we're talking about, maybe you have a permanent disability, either arising out of an accident or out of a disease, a critical illness, then that is something that is also covered. I think we've also talked about waiver of premium. And a very, very critical one, there are some policies that have a retrenchment cover. And this one pays in case you are retrenched by your employer, if you're employed, then this will pay you a maximum of up to 1 year of your monthly salary. So up to 1 year. And especially with what has been happening, hard economic times, post-COVID, and even during COVID, a lot of people were then laid off. People who had this kind of cover, at least it was able to cushion them over a period of time. And this I encourage everyone, even if it's not attached to your education policy or your life cover, then you can either purchase it. And right now, most insurance companies are selling it in conjunction with banks. So you find, for example, StanChart are selling one that is with Prudential Insurance that's called Advantage. Then you find Stanbic are also working, with a different insurance company, and they have theirs. You'd find also ABSA have also come up with their own retrenchment cover. And normally this is tied to you having a salary account with the bank, because that is how they verify, one, that you're employed, and that, salaries are coming. And of course, when you're laid off, the bank will of course note that salaries are no longer coming. So like we said, because, insurance covers risks, and one of the critical risks to the education, of your children is actually your loss, not before even death. Death is really at the end, but really you could lose your income. And then what happens? Maybe you lose your job, you're not able to get one, as quickly as possible. Then at least this retrenchment cover can carry you. And then we have some education policies that have this as a rider, and premiums are really minimal. So you'd find for about 1,000, about 1,000, maybe 1,060 shillings, like the one for Prudential per month, then, that gives you, a cover of whatever your salary, for whatever your salary is. But it can be as low as that amount of money. But of course, again, it is back to your salary. So let me emphasize, this is a really critical one when it comes to education planning. So other features are premium payment. And you see, this is the amount you pay the insurer, to be able to purchase cover. And this can be paid either monthly, quarterly, semi-annually, or annually. Then you find if you're paying quarterly, semi-annually, and annually, because you're paying, you're prepaying, you find then the insurance company will normally discount. Like if you calculate, say how much, say you're supposed to be paying, say like 3,000 per month, for example. You see, in 3 months' time, you're supposed to pay 9,000, but you can find if you're paying on a quarterly basis, then probably this 9,000 is discounted by a factor. So maybe you're paying either 8,900. Then you find if you're paying semi-annually, the discount is more than the quarterly discount. And of course, if you're paying annually, then the discount is even higher. Now, I think now that we're on the issue of premiums, what happens? What happens if then you started paying your premiums, but then you stopped after 60 days? Maybe something happened, either you forgot, circumstances changed, and you're not able. Now, if you've not paid, and this is normally insurance, and that's why I took the lower number. If you've not paid your premiums for 60 to 90 days and you've not informed the insurance company that there'll be a delay, then your policy will automatically lapse. So if we are, and this is where I encourage now clients, if you know circumstances, and life happens, things could change for you. If you know you'll not be able to meet your premiums as they fall due, and especially for something like an education policy that is really a savings product. Maybe you were paying, 30,000 per month, but now you're out of work. Maybe what you can afford to pay from maybe your other investments is 5,000. Then please talk to your insurance company and tell them, circumstances have changed for me, and either can we suspend my policy because I'm not able to pay at all? Are we able then to what is called redating, or then can you recalculate it for me? So that now for this period of time, either 6 months, 1 year, I only pay 5,000. So insurance companies are normally flexible, but then what the problem normally is if you don't tell them, then your policy will be cancelled and any benefits accruing are also lost, especially if the policy is below 3 years or 36 months. And this is where that word we'll have to hate surrender value. So if cover lapses within the first 36 months, then there's zero refund. Whatever it is, it doesn't matter that you are paying 100K, per month. If you stop, you did not inform your insurance company that you're stopping, then there'll be no refund to you, because the way insurance policies are structured is that they front load all the expenses. So you find in the first 3 years of the policy, the insurance company actually is making nothing from. You could be giving them 100K, but because of regulation, because if it's coming to an intermediary, there's an element of commission that needs to be paid. All those are front loaded within the first 36 months of the policy. So if you try and surrender your policy before then sadly, and it's important to note, there'll be nothing payable to you. And that one, it becomes a very painful thing. So even if you're thinking maybe of terminating the policy, at least wait until it has attained a certain surrender value. And now when it comes to calculating the surrender value, they look at what is the value of the policy to date in terms of how much have you put in. Then they will factor in any admin costs, of course, to date. And then because you're entitled to a policy loan after 3 years, perhaps you've taken a policy loan and it's still outstanding, they'll also knock off any policy loan amounts that are still owing or outstanding. And that is how then they arrive at the surrender amount. Now, some insurance companies are transparent. They'll tell you upfront, this is the calculation for surrender. And some will even go as far as publishing it on their website, or putting it very explicitly on their policy document. Majority, if you look at your policy, that may not be very clear, but it's something that you can ask for. If it's something that you're considering, it's something that you can call up either your agent. Sorry. Excuse me. You can either call up your agent or the insurance company and ask them, what is that? At every year, just find out what is the surrender value of, of your policy. So I hope we are clear. Asiko, good up to that point?
Yes, we are good.
Okay. I think we need to run.
We are okay, but the time,
yeah. And I think we'd also talked about bonuses. These are calculated at a rate prescribed in the policy. So benefit payout, how do benefits get paid under an education policy? One, we talked about maturity. That is at the end of the policy term. If there were specific payouts designed in the policy, maybe the 7th year, the 8th year, the 9th year, for example, then those will be paid when due, and it's almost automatic. Because you see, as you're signing up, you'll give even your bank details to your insurance company. The good ones will call you maybe a month, 2 months before a payout, just to confirm your details. This is coming up. There's a payout coming up in 2 months. Please confirm that this is your preferred mode of payment, and these bank details are still valid. So that is when benefits are also paid out. Again, now, if you had a critical illness rider, then when there's a first diagnosis of a critical illness, then the policy will pay out either a defined amount, or some policies have 50% of whatever the policy value is. Then upon a certified permanent disability of the policy holder, this must be, of course, certified by a doctor. Following an accident or illness, then the policy can also pay out. Then again, upon death of the policy holder, now it's important to see what notes. If, like given the example, if you've taken a 15-year policy, maybe you die year 10, then if the policy had a sum assured of say 5 million, it will pay that. Then the policy will continue to run until the year the payouts were to start, because maybe the payouts were to start from year 15 and this is year 10. So it's really important to also note this amount, how much, because you find some policies have a very, negligible sum assured. You find like 200,000. For example, if it's 200,000, that is, the inbuilt life aspects, then you see this becomes a very small amount. It is an amount, but a very small amount. So it's something to really critique even when you're purchasing an education policy, because it may not be sufficient, in the event, supposing you don't have another life policy and this is all you had, then 200,000 really will not do much for your dependents. Then what happens? Now it's important to know, and that's why I was giving definitions. The policy holder is not normally the person taking out the policy. The beneficiary could be a child. Now, if the beneficiary, if you've taken and noted the beneficiary is, say, it's only one child who was on the policy and they passed on, then premiums may be refunded. If you have another child, maybe that you'd want to substitute, then some insurance company will allow you now to nominate someone else as a beneficiary and then to continue with the policy. So it's important to note that the policy, yes, has the child as a beneficiary, but should they pass on, then what happens is because it's the policy is on the parent or the guardian, the person taking out the policy. If the child as a beneficiary passes on, then either premiums are refunded or you may be allowed to substitute. Then again, key considerations, your age. When you're taking a policy, the older you are, the more expensive. So the earlier you take a policy, the cheaper it will be. And today is, today is the youngest you'll ever be. So yeah, just putting that out there. Then again, the age of your children. And again, why this is important is that you need to also factor the accumulation effect when you have more than one child. And sometimes, when you're dealing with one child, it is easy to plan and you're able to do the figures, quite well. But sometimes when you calculate, especially when you look at your own child, like I was saying, do a map. What is your current age, the current age of your child and the spouse? In another 10 years, where will you be? Where will each child be? And what will be the education demands then? Like for me, like this year, I just from my own example. So we have the 20-year-old who's a third year in uni. Then we have another one who is in class 8. So he's doing the last ones who are clearing with the 844 KCPE. So he's in school. There's also the school fees. And then there's the younger one, the youngest, who's like 3 years. So who was joining school. And so come January, the budget suddenly, shot up because of now the additional member of the family who now needs education. So it's really important. And when we're looking at the case study, which we'll get into next, you'll see the effects. Looking at one child in isolation is okay, but when you look at your age, you look at the age of your child, where there will be each one of them and what the education demands will be at that point X in time, that should advise really how you go about planning. So don't look at each child in isolation, look at also when they all meet together and all of them maybe have high cost demands when it comes to education, what will that look what will that look like for you? So again, escalation and inflationary factors, we had talked about this number of children. This is tied again to that accumulation. And again, what is it you can afford to pay? So we'll get into the first case study. And here we are assuming that the age of the parents to date is the parent is 35 years old, and the age of the children are 9 years and 7 years of age. And since I said we'll be using the CBC education system, these children are in grade 4 and 2 respectively. Then you as the parent, you've done your math and seen, you're well able to handle primary education. And so where you think you need help will be in, in universities. That again can be very different, because if you say your children are in the IG system, then the cost in high school could really be even more than some of the private universities we're talking about. So it's important, even as you look at your income, your resources, and where you have chosen to have your children educated, maybe the demand for you may come earlier than university education. So school fees and other costs, here we took a business degree at Strathmore. It came to around 800,000. When you factor in all the things I was talking about, tuition, meal, if they are at Strathmore, of course, they do not offer accommodation. So maybe your child is at Kwetu, that is near Strathmore, meals, accommodation, incidentals, then it was coming to about 800 annually, as in 2023. Then we'll assume, let's adopt, because as per the CBK, I think as of January, inflation was at 7.95%. So let's approximate 8% as the inflation. Could be lower, could be higher. So based on this, it will take 9 years for the first child to get to university. This grade 4, boy or girl. Then it will take the second child 11 years before they join uni. Now, when we put that in a table, so assuming, now here we're looking at your age, future age, when these children now will be going to uni. So in 2032, the parent who is today 35 years will be 45 years of age. Child number 1, who was 9 years, will be in year 1 of uni. Child number 2 will be in grade 11. I'm sure, since I understand you guys went through, an investment cost, that some of the things you handled were, the future value of money. That in 2032, the costs, if the cost today is 800,000, then using, the future value calculations, this 800,000 will have escalated, at the rate of 8% and will now be 1.59, say 1.6. So that is what will be required for that child in 2032. Now, so for the second child, since they're still in grade 11, you're still handling that, no problem around that. But this is what you need in year 1 for them in uni. Then in 2023, when they're in year 2, it will be 1.7, again, using the same escalation, 8% over time. Then the future value of that 800 today will be 1.7. Now look at what happens in year 20, 34, and 35. This child is like my daughter, is now in year 3 in uni. And these are the one who was 7 years, today, 7 years today, is now also in year 1. So this now, the year 3 student will be requiring 1.8, same as this one who's just joined. Because it's the same amount of time and the same kind of escalation. So for that year now, you'll be requiring double the amount. So it grows now from the 1.8 million that maybe was not looking too bad in terms of handling, but it is now at 3.7. Note, and that's why I'm putting age of parent here. Note you are 46 years of age. If you don't have a proper plan, these become then the very stressful years of your life. When all your children meet together, and probably there's another one now who's been born. No, the one we normally say for carrying slippers in retirement, that one is also being born, and maybe now they started school. So that will further now add to this. Why I'm putting age here is so that you can also reflect, where will you be? By the time you're 46 and 47, for example, where are you? Are you still in employment? Are you running your business? What do your savings and other investments look like? Because you see, we said you can fund education from either, if you're still working, if you're in business or self-employed, then it's either you're funding it from income. How much are you earning by then? It's also important to project how much do you think you'll be earning by then if you're still in employment, or how much will your assets then have grown, your passive income, at what level will it be, in age. Now, I use 35 years. If say today you have the grade 9 and the grade 7, and maybe you're 40 years, you're already 40 years of age, this math looks very different for you. So it's important everyone sits and does that. Look at 10 years from now, when my child will need to go to uni, because maybe that's where you're anticipating that the need will be, then what will be happening, not just around the child, but also around you and around all your children. So I hope this is clear. So by 2035, then the first child has dropped out of school. So now you'll only be requiring school fees. The burden lessens a bit. If another child now has not come in and, caught up with these ones, then you'll be requiring a lesser amount. So for child 1, for those 4 years, you'll be requiring a total of 7.2. And for child number 2, 8.4. And this comes now to a total of 15.6 million. I think because of time, let's just move quickly. So I hope that is clear. I hope that is clear in terms of what will be required. So we look at a different case study. Again, this is someone, the same parents, same children, but this one now you decide to take them to do a degree in medicine at UON. Surprisingly, the fees were coming to around the same. It's only now, since they're doing medicine, they've been in school for 6 years. So because of them being longer in school, you can see now child 1 will require 11.7, child 2 will require 13.6, and for the both of them, the total required is 2.5. Again, please note, when you plot in your age, if you don't have a plan, then these years can really be stressful for you, because either the children will not go where you wanted them to go, or then the financial burden around here. And you see, these are those midlife years, and maybe you can understand why people experience midlife crisis. These are some of the things that without a plan, then this becomes a very huge burden. So the third case study we're looking at, and we're looking at Ivy League university in the US, and these are the Ivy League universities: Brown, Columbia, Cornell, Dartmouth, Harvard, Penn, Princeton, and Yale. And for purposes of the case study, I took Princeton, and but generally the costs are around the same, around this USD 76,000 annually. That is if, and when you look at the figures, you'll see some shocking amounts. So if your child does not get financial aid, then this is what you'll be required to cough up in year 1. And however, if they do get the maximum financial aid, then this drops to 15,000 US dollars with financial aid, sorry. And here I used an exchange rate of 126.5, which is the sort of current average. And this will give you now about 9.6. That's if without financial aid per year, and 1.89. That is with financial aid. Inflation in the US is lower than in Kenya, so I took 6%. Again, the time before university, since we're assuming CBC is the same. So you can see without financial aid, some very astronomical amounts of money that will be required. For child number 1, a total of 71. Child number 2, a total of 79. Child number 3. So even as you aspire, it's important then you do that, with a realistic view, and either then you really need to be saving and in a better income, more aggressive in your investments, or now you start praying. You start praying now, between now and then, that your child will be amongst the ones that get financial aid, because then the costs are much lower. Year 1 is 3.2, year 2 is 3.3, 3.6, 3.8, 14 million we saw previously, and 15 million as opposed to 79. and 150 versus 29. So this at least is giving you, even as your goal setting, as you're looking at the target amount and are looking at the avenues, is it income? Am I able to generate, from my salary or from my business or from my passive income, my assets, my investments, my savings, are they able to give me money that can enable me to pay these? And please note, this is not the only thing you'll be doing. You're also believing, hopefully by now, you don't have very many other major costs, hopefully, but you could also have many other major costs. So it's important to take that into consideration, even as you aspire. So this is a summary of that. If it's Strathmore, then 15. If it's UN for medicine, a total of 2.5. Princeton without aid is 150, and with aid is 29. Now for the 2 children and over that period of time. So then what are your options? So if we allow me now, I think because of time, we'll only handle scenario 1 so that we can also have time for questions. So
Yeah.
child 1, if I decide now one of my ways, and now here I'm zeroing in on an education policy. So I'm saying my child will go to Strathmore, and child number 1, because in 10 years time is when they'll be in uni. I'll take a policy for 10 years, and I want this policy to have 4 payouts from the year 2032 to 2035. The monthly premium for that, and I just took an example from one of the insurance companies, will be 66,549. The total premiums I will pay over that period will be a total of 7.9. Then since these policies, like I said, they also have bonuses. So the payouts plus the bonuses come to a total of 11. So when you net off what you have paid in premiums and what the payouts and bonuses will have paid you, then I would say that there's been a gain of 3.4 over that period of time. Now, child number 2, you need to take out a 14-year policy with 4 payouts. That premium, because it's over a longer period, is slightly lower at 66,115. The total premium you pay over the 14 years is 11.1 million. The total payout from the policy plus bonuses will be 14 million, and the gain of that will be 2.9 million. So for both policies, you will have the payouts will be a total of 25.5 million. Again, it's a total premium paid of 19. And I guess the gain, and why I'm saying gain, I'm using the word loosely, is because people tend to compare education policies with investments. So I'm also now, trying to do a comparative analysis with that. So this company is one of the policies. So in other words, you'll be paying almost how much? The 66,115 and 66,549 per month. So almost 134,000 there on a monthly basis. Now, why is that important to notice? Because is this something that is affordable either from your salary? Or see this, you start financing and preparing now. Does it make sense from your current salary to be putting aside 134, 34 per month? Are you able to, afford it from your salary? If not, are you able to afford it from your investments? Or are you, okay, we said we're not going to debt, so we'll not even discover debt. So we're looking at income and investments. Are they able to cater for this? And again, should something happen to you, at least with an insurance, if something happens to you, you lose income or you're diagnosed with a critical illness, then because of that aspect of risk mitigation on an insurance policy, at least, there'll be a mitigation around that. However, if you're going the pure investment way and without any risk mitigation aspect, then should something happen to you and now maybe your investment portfolio, was not all that, it hasn't grown that much, because see, it grows over time as you continue to put in. Or maybe now your income is curtailed, this 132 can be, quite a bit to handle. And either you'll have to surrender the policy if it's from income perspective. So what is going to fund this? You must always ask yourself, what is going to fund either this premium if it's premium, if you've decided to go the education policy, how else are you going to fund that amount? So I took an investment like money market, that if you put the same amounts of money that you'd be putting in the insurance policy per month for 10 years, I think averagely now money market is around 8%, give or take. Then, if you put in all those factors, then you'll have made a total contribution of 7.9, but then what you'll have accumulated over that period will be 11.5. That's for the first child and for the first child. Then again, if you put the same amount for 14 years at 8% for the second child, then here you'll have 19.2 million, and your total contribution against that would be 11. So here a gain of 8.1 and a gain of a 3.5. So total interest that you'll have gained now from those would be 11.68. So that's why I'm saying, when you pit against now the gains on the insurance policy, that when you pit them one for one as investment products, then you see the insurance policy would never stand up against an investment product, because that was not its design. Part of the premium you are paying is going to handle risk. It is the one that will cover death, disability, critical illness, retrenchment. Then the other bit is now now what is actually saved on your behalf. And of course, they're not giving you 8%. Maybe they're making more than that. Maybe then they are trading in other, in other assets, other forums that are giving them a much higher, smaller amounts. And that is how insurance then products work. They are savings with a risk element that comes at a cost. So it's important, even as you're considering that, to really critically then be able to match that two against each other. So then, so again, and I think there was a question, so is it better to take an education policy that, that combines both savings and risk? Or do I address risk separately and I can handle my savings and investment separately? So we'll also be looking at that scenario. So since this life policy is on the life of the parent, let's assume, since we're looking for Strathmore about, give or take about 16 million. So we'll take that as a sum assured of 16 million. Then with this, since, like I said, critical illness is normally at 50% of the main benefit. And also we're taking accidental death, you can take, it can match the sum assured. So for this, the cost per month for you will be 13,843. And this allows you to pay over 20 years. And then the total payout, the total you'll have paid out is 3.3 for a benefit of 16M. And here, if anything happens to you, if you have a first diagnosis of critical illness, you've not died, at least this 8 million can come and cushion you against that. If there's, you see, accidental death goes with disability. If you're declared, you're still alive, but permanently disabled to the extent that you cannot work, then the policy will pay 16 million. And it will still pay another 16 million in case you pass on. And then again, in case you pass away, it will still pay 16 million to your beneficiaries on the event of your death. So if you were to ask me, what I would do is I would take out a handle risk as risk, because it's more efficient. Because you see the difference between 13.8 and 13,132 is, it's quite an amount. Then I'd put in, I would not need to put the full amount in money market. I'm assuming, I just took the example of money market. Of course, there are more efficient ways of investing, but for ease of, illustration, I went with money market. Then I'd put 55,000 per month in money market for 14 years, assuming the same, interest rate maintains at about 8%, and that will give me 15.97. And this will cost me, the two of them will cost me a total of 72 per month, as opposed to the 132 if I'd chosen to do an education policy that both has savings with elements of bonuses and also handling risk. And the total cost of the period will be 12.5 across, as compared to 19 million that you'd pay out if you take an education policy. And so I think in the interest of time, I will not go through the other scenarios, the ones for UON. But I trust that this gives you now a gist of what your target amount is and how, if you were to handle using an investment instrument or using a savings instrument that is particularly insurance, you know how they compare against each other, and you know what are the pros and cons of each. So that is, I think we've come to the end. I can take any questions that I've already not addressed, but this is part of what we do, like as part of custom fleets, then do a lot of health insurance. I'm particularly very passionate, I don't know, about retirees, because it's where we all end up. And what I've discovered by experience, maybe by dealing with people in that age bracket, is sometimes we're ill prepared for that. So either in terms of a medical bills planning, or in terms even of, pension. Do you have enough pension to take you through retirement? And I think since I believe, hopefully, I've earned another conversation with you, that we can tackle that a bit when we talk next time. So over to you, Asiko, for questions.
Thank you so much, Mercy. I'll just jump right into the question. So there's a question: what percentage of net annual income should one spend on education? And then are bonuses stipulated in the policy documents? I think that someone actually answered. Is there a maximum limit for how long a policy can be suspended? Which insurance companies are transparent about surrender value? And then if a policy document is unclear about some terms, e.g. surrender value, can one negotiate and have these terms stated clearly before signing up? That's it.
Okay, I think let me handle this. When it comes to bonuses, these are clearly stipulated. And sometimes I think what insurance do to cover themselves, sometimes they say this could change. So they'll say, like, say it's 2.5% of something, or is a certain amount, but subject to change. Because, again, they also cannot predict the future. So in terms of covering themselves, they would say maybe they can guarantee a minimum of this, but, subject to, so you find it's always stipulated, and sometimes with conditions. But normally it will be stipulated. They'll give an amount either as a percentage, either of the sum assured, or a percentage of the accumulated value, at the end of the period. So different people have different ways of handling it. Now, normally when it comes to suspending a policy, I think between 6 years to 1 year, in terms of what I've seen from a practical perspective. But then sometimes this is on case-to-case basis, but this would be the standard time. And what would normally happen if now, especially over 6 months, sometimes the insurance company would sometimes insist either you need to go for a medical, or they'll put a waiting period when you come back that you cannot make a claim within, certain, because they could also be suspecting you that maybe you suspended it and now either you've been diagnosed with a critical illness, and why now you're coming back to pay is so that then you can, just benefit from the policy. So you find then sometimes over 6 months, they tell you, yes, we'll reinstate the policy, but, we'll have a certain waiting period for within which you cannot claim for any benefits. So in that, if, of course, they cannot put waiting periods for accidental death, because, it's an accident, but things to do now either with natural death and critical illness, or some of these other additional benefits, then those could be subjected to a waiting period. Again, this differs from insurance company to insurance company. Then clarity. I think let me also do some education around this. We have what is called the Insurance Regulatory Authority, and there's what is called treating customers fairly. And one of the requirements imposed on insurance companies is that you need to be transparent. Your policies need to be in easy English, easy readable English, where the common person who's not, is not an insurance expert can easily be able to understand terms. Now, if something is not clear, the burden is on the insurance company to make it clear to you. And it's something that you can raise directly to them. If it's not, like put in the policy document, it's something you can raise with them directly. No, I'd want to be, this is not appearing in the policy, and I'd want to, get clarity on how this is handled. And they are obligated by law in terms of treating customers properly to give you that information. However, if they are not playing ball, then you can raise a concern with the Insurance Regulatory Authority, the Consumer Protection, and they normally then would deal with such, and they either would penalize if it's something maybe that has something that has prejudiced you because you did not receive certain information. Maybe even around bonuses, maybe what you received at the end of the period is very far from what your expectations are, or what you are led to believe. And especially documented things, and where information is lacking, then that is always construed. The lack of information is always construed against the insurance company, and either they'll be compelled now to now have that in their documents, in all their documents, or if it's prejudice, if you have incurred any financial prejudice out of it, then they'll also give awards. They are mandated actually as a legal instrument to give awards and compel insurance companies, if so found, found culpable, to then pay certain amounts of money to, to whoever it is who's been injured out of what they have done. So that would be my response to that. And I think there's one I haven't quite handled, the one on which ones. I think let me come with a few samples of people who've actually gone out. Next time, the next conversation, hopefully, then I can come with samples of, how people who has been transparent and what have they said. And maybe just to also hear now from the audience, that does that really speak to you? I mean, do you feel like you're well covered? Is it, clear? Are you able to calculate simply this? Or has it been put in such a way that leaves you more confused than, than before you read about the surrender value? So that is important. That is important.
Did you answer what percentage of net annual income should one spend on education?
So on average, I think rule of thumb from financial advisors, I think they say about 20%. 20% to be on the safe side should be either going towards direct, especially if it's something for planning. And here I'm talking about no direct expense, but where you're actually planning around it. Then 20% of the income you have today then should be going towards, towards education planning.
And then I have a question. There's usually a clause on tax relief on the insurance documents. How does one go about to even get that?
All right. So what happens, I think as per the law, you are entitled, if the policy is 10 years or more, then you are entitled to 15%. 15% of what you paid as premium, up to a maximum of 6,000. So what happens when it comes now to the time of giving your tax returns, in the insurance companies, you can request and they'll give you the tax relief certificate. So either you can get it in advance, if depending again, if you're employed, then you're able to get that in advance and give it to your employer, and they are able then to give you the relief at source, from the payroll deduction. However, if your employers are very different, some of them really don't want to go into that math. So they tell you this is insurance, it's your personal business, you handle. So what will happen is then at the end of the year, when the tax returns are due, then you get this relief certificate. And when you're doing your tax returns, then you'll calculate and then you'll be able to claim a refund from KRA. Whether you'll get it or not, yes, is yeah, your guess is as good as mine. Normally, getting refunds is not very easy, so it's normally better if your employer is a good employer, people friendly, then they should be able to deduct this at source. It's always easier.
Can you backdate that? Say you have not been using the certificate and probably now you're year 5 into the policy.
No, because you see, you already did the returns and you did not claim it in that year of return. So for this, some of these personal benefits, they'll just tell you now that one has lapsed. Now, look at a fresh year.
Okay.
Yeah.
If there's anyone else with a question, you can just unmute and ask the question, because I read all those that were in the chat box.
Okay, but I trust we have covered like all the questions that had come up earlier.
Yeah.
Okay.
Okay, I can't see any other questions, so I'm assuming you guys give me an emoji like you're okay, or this was clear. Give us a sign.
That's a challenge with virtual trainings. You could be speaking to yourself for all you know, unless people give a sign.
Yeah, that's true.
Yeah.
Okay, but yeah, I think they're emojis, so they are okay. I'm to assume that they're okay. Thank you so much, Mercy. Thank you for your time. Thank you for the education that you've given to us. For sure, we will call you again for another session on retirement or any other topic. But we're really grateful for your time. Investable community, thank you for showing up. I hope this has been fruitful. I hope that going forward, you're now more clear, even as you think of maybe signing up for a plan or going through what you had before. So I'm going to wrap this up and wish you all a good evening. Unless Mercy, you have something else?
No, and I mean, I think I've given my contact, so feel free to reach out, maybe to interrogate maybe current policies. I'd be happy to help you interrogate if you've already taken an education policy, to help you interrogate that of your thinking of, a better way, especially on the insurance aspect, just to go through that. It's never too late. It's never too late. And maybe just one conversation can, help you get out of a mess or bring you clarity. So happy to have the conversation. So please feel free to reach out. I'll be happy to walk you through that, or any of the other products that we are dealing with. If you have a need in that area, then I'll also be happy to assist you with that.
Okay.
Asante sana, I'm really
Thank you.
I'm really happy to have been here. Asanteni.
We'll see you on the 9th.
Yes.
Okay. Thank you.
All right. Sawa sawa.
Okay. Good night.
Okay, good night.